Hi, welcome back to MF Corner. Joining in now is Mrin Agarwal of FinSafe India, and she's going to tell us whether we've been checking our returns from the investments right or wrong. Hi, Mrin. Good afternoon. Thanks very much for joining in. You know, the favorite Sunday hobby of most people is to check, how schemes are doing, or perhaps look at historical returns to see, what they should be considering as the next investment opportunity. But have we been checking our returns right? I mean, something tells me that it's off.
Good afternoon, Samara. Nice to be here today. Well, most people, and I would say most investors, tend to track pre-tax returns. And there's a whole lot of difference when you look at pre-tax and post-tax returns. So the right thing to actually check is not only the post-tax returns, but when you really want to evaluate whether you've made the right investment, which has not only beaten the benchmark, but also given you a decent return, then you need to look at the post-expense and post-tax return and not just look at the gross return, which is what most investors tend to do.
Okay, so that's fair enough. But say when you're comparing investment options, right? So for a FD, it may be easy to calculate. For complex financial instruments, not so much. So, how do you find out which instrument is most tax efficient?
Well, right off, I would say mutual funds are the most tax efficient. But for example, when you are comparing a fixed deposit, which is at 7%, you're looking at a return of around 5% post-tax. But when you get the same return in a debt fund, you're looking at a 6.3% return, which is a lot of difference, right? 5% versus 6.3% is quite a bit of difference in the overall returns. Similarly, when you look at equities, so PMS and equities obviously is 10% long-term capital gains post 1 lakh rupees. But I have seen investors who are doing F&O and who are comparing F&O pre-tax returns with equity mutual fund pre-tax returns. And F&O, as we all know, is treated as speculative income. It's treated as business income, which is going to be fully taxed. Again, these days, I see many investors comparing REITs along with debt funds. But again, if you're going to get a 7% pre-tax in a REIT, remember that in the REIT, the distribution is in form of dividends, in form of interest. So dividend could be tax-free, but interest is not. Interest is going to be fully taxable in your hands. So there's a whole lot of difference when you actually compare returns, or if you're evaluating how an investment has actually performed. It's a lot of very different when you're looking at post-tax returns.
Okay, fair enough. But expenses also play a big part, right? And say for mutual funds, we know the expense ratio is well known. The NAV that is published is post all expenses. But there are some investments where this expense ratio is not included, right? It comes later. So how does an investor then assess those returns?
Yes, it's so important. And the one instrument that I can think of, which is so common in India, where the absolute wrong comparisons are done, are ULIPs. So when you look at the average ULIP returns and the average mutual fund returns, you don't see that much difference. But remember the ULIP returns that you're seeing published. So the published ones that you can get off the internet, these are basically only fund returns. On this, there's going to be the mortality charge, there's going to be fund management charge, and whatever else charges are there are going to be applied on this. And hence, when you actually see the investor return, and although this return might be tax-free, but when you actually look at the investor return, you find that from, let's say, 11% return, you're probably down to less than 6% as far as the investor return is concerned. And this is mainly due to expenses. There are instruments which investors are considering which have performance-based fees, for example, AIFs, or most PMSs also have a performance-based fees. And with performance-based fees, what happens is that beyond a particular hurdle rate, there is a profit sharing. So let's say if a fund has generated a 25% return and they have a 20% profit sharing above 10%, it actually translates into a 3% performance fees, plus if there is a fixed fees, right? So many times what happens is that people just get blinded by this overall gross return that they're seeing. But remember that if you're having a 25% return with a 4% expense and then you are paying tax on it, the overall return is not 25%, it's probably 18-19%. So these are factors that are really important, and this is the right returns that you need to look to compare any investment which is post expense, post tax return.
Okay, fair enough. And is there anything besides this which impacts returns?
Well, from an investor perspective, when you're investing anywhere, you need to see if you're beating inflation, because if you're not actually beating inflation, then you're really not growing your money. So you need to look at the real return, which is netted off for expenses and taxes. That's the final thing that you really need to look at to see whether whether the investment is worth it or not.
All right, Mrin, thanks very much for joining in and for explaining this to us. Well, I guess we've all been guilty of just looking at the headline number. But like Mrin says, the best way to look at returns, to look at the realistic return on your portfolio, is to look at post-tax, post-expenses returns, and where it's not applicable or where it's not clearly mentioned, investors must find out and then check the post-tax returns. Well, with that, we have come to the end of MF Corner for today.